Cool. Okay, let me know once it's started recording then, and I'll crack on. Okay, guys, welcome to Nailing FX. This is swing shot, so hopefully that's clues in the name. Swing, we are doing swing trading. We'll look at swing trading opportunities. The good thing is, if you've seen any of my colleagues trade Nailing FX in different ways, that the methodology that we use and the technology that we use is the same. So just because this applies to swing shots doesn't mean you cannot apply it to day trading or even long-term investing with Forex or even other markets as well. So just a quick introduction. My name is Becky. My email address is becky@tradewithufos.com. And you've also got this link here, tradewithufos.com/Becky. So I'll just briefly take you to that and just explain to you what it is. If you go to that link, then you can get yourself set up with a free Trade with UFOs membership. That will mean that you get access to a market commentary every single day that will be emailed to you, and you'll also have access to certain discounts every now and then, and to recordings of sessions that we do. The other good thing about this link is that once you have a free Trade with UFOs membership, you can come down and you can ask questions in a public setting, which is good for other people. So it may be that if you have questions, rather than email and wait for a response, you may come here and see that the question you have has already been asked and the answer is already there, which is helpful for you. If it's not already there, then you can ask it there publicly. We'll answer it publicly. And then it means that everybody else can kind of learn from that experience, or learn from that question as well. So we prefer that you ask questions on those links. So for me, it's tradewithufos.com/Becky. If not, you can email me, which is becky@tradewithufos.com. Right, I just need to make sure that the disclaimers there are being highlighted, so you can see those there at the top. Obviously important for you guys to read them, as it will be recorded. Of course, you can pause it and read them if you'd like to read them in more depth. Important that you guys understand disclaimers before you watch these kind of videos. Okay, so first things first, what I'm going to do is have a quick look at what happened last time. So last time, the session that we were in a couple of weeks ago, just going to switch this so we can see where it started. We put a trade on for the euro versus the New Zealand dollar. Now, so I'm just going to switch it again here so we can definitely see everything. There we go. So this is what's happened to it. So overall, that trade worked a little bit, but of course, we had markets go against us in the end and break this area and stop us out. Now, the good thing is that we have our safety target. So because we hit our safety target, what that means is overall, we didn't make any money, we didn't lose any money. We broke even because we made 1-to-1 when it hit this line. So what happened is price came in, entered here. Let me just draw it out. So price came in, entered at this point, moved away, went as far as here, obviously so far hitting our safety target, and then came back against us like that. So it would have stopped us out there. So overall, we made 1-to-1 and then we lost 1-to-1, which means we broke even. So not a big deal either way. That's why we have our safety target. Imagine if we'd have had a target further away. Let's say, let's just make it up. Let's say it was here. Price never got there and then moved against us. This would have just been an out-and-out loss, which is why we have our safety target relatively close or quite close, so that we can avoid that happening. And even if we're only right a little bit, but not fully right, we still don't lose any money. So that's the plan. So that's what happened on the trade from a couple of weeks ago. So now we want to have an idea of what we're going to do moving forwards today. So we'll see what opportunities we have. First things first, I just want to check out the economic calendar, FX Street economic calendar. So today being Wednesday, it means that we need to have a look at what's coming out today. So we have a couple of things coming out on the euro and some things coming out on the US dollar. Now, what we do, or what I do, is filter by high impact news up here, high impact news, and I filter by this week. So again, you can filter depending on which currency pairs you use, but I'm kind of looking at all of them. So for today, just to be aware, this is all in Eastern time. We've got a few things coming out on the euro, and again, something coming out on the dollar, which may increase volatility. If we have an increase in volatility, it can increase risk, so be aware of that. Doesn't mean don't trade it, doesn't mean limit your risk doesn't mean limit the amount of trades. Those are interpretations of that, very fair interpretations of that. Volatility increases risk, so you might want to manage your risk a little bit better, i.e. place less trades, use less percentage of your account, or maybe even avoid those kind of markets. For me, it's just something I want to be aware of. So maybe I won't put many euro trades on, for example. And then tomorrow, a few things coming out on the Swiss franc, the euro, the pound, the Japanese yen, and the dollar. So again, something to be aware of and interpret it as you will, depending on your risk tolerance and what you want to do. So that's that done. Now let's move on and have a look at some upcoming opportunities that we may have today. So, excuse me, got a bit of a frog in my throat today. So what we want to look at on these scanners, first and foremost, is where we have these yellow boxes. Now, I'll explain why some of them are the ones that we'll pay attention to and some of them are not. The yellow boxes are telling us that we have a near opportunity. And that's helpful because if we have a far opportunity, one that's far away, it means there's more time and more price movement where conditions could change, and therefore even by the time it gets there, it may not be a good opportunity anymore. So near opportunities are good. It means that they're less likely to change conditions before they're triggered, meaning they're still valid. And it also means we get into trade sooner rather than later, rather than wait about. So that's what we want to do. We want to look at these near opportunities. Now, further to that, some of them say near hopeful, like this one here, that says near hopeful long. And some of them say near sensible. So what we want to do is focus on the sensible ones. Hopefully that makes sense. When we're trading, we want to be as sensible as possible, not hopeful. So hopeful, obviously it's literally telling us maybe keep away from that. So we're looking at the yellow boxes that say near, and then we're filtering down more from that and having a look at the ones that say sensible. Now, there is one more thing that we want to look at, and that is these boxes here that are on the left-hand side of our scanners, really. So these boxes are important because they tell us whether or not we have probabilities up or down or nowhere. So if it's a blue box, that tells us we have probabilities to the upside. If it's a red box, that tells us we have probabilities to the downside. And if it's a grey box, it tells us we don't have probabilities either way. So we'll not waste our time, not go and have a look at opportunities like that if we don't have enough probability. So we're using those three things, whether or not it's a near yellow box, whether or not it's sensible or hopeful, and what the color of the box is, to then narrow down where we place our time and energies looking for opportunities. Now, as traders, as Forex traders, you may have watch lists that you go through and you may just run through this one by one, totally fine. I prefer to use the scanners because I feel like it saves time to be able to just go, okay, these are the currency pairs that have better probabilities, so let's then have a look at those. But like I said, if you want to go through watch lists one by one, that's also fine. Also, just to say, the methodology that we go through, we are using technology. This is one example of using technology in a way that helps us out, because it saves us time. But we're using technology all the time to help us figure out, should we be trading yes or no? Should we be long or short? If so, where exactly? And where do we put our targets? So we're trying to be objective as much as we can, and we're trying to use statistics and technology as much as we can to avoid being subjective and kind of interpretation that could obviously change day by day, depending on how we feel, depending on what's going on. So we want to be objective. We want to use technology to help us be objective. Saying that, you might be watching this and you've already got a strategy that works for you. Great, keep doing that. Maybe you just want to add in these scanners, for example. Maybe you just want to add in the way we manage our risk. Maybe you just want to add in Autoclimate as a free app that will help you to decide whether or not you buy or sell. You don't have to do the methodology that we do start to finish in order to be successful as traders. There are thousands of ways to be successful as traders, and that's totally fine. So hopefully, as I go through our methodology start to finish, even if you don't want to do the entire methodology start to finish, there will be examples of different steps along the way that make sense to you that you feel you want to incorporate into what you already do. Or perhaps you say, no, that's cool, I'm going to go start to finish in the way they do their methodology. Again, either way, it's whatever makes most sense to you. So considering, like we said, we are looking for near sensibles, and we are looking for where we have boxes that are coloured in. So that rules out these two. That's near sensible, that's near sensible, but both have grey boxes, so we'll ignore them. So we're going to come over to our cross pairs. So we have near sensible long on the Euro Swiss with a blue box. So let's take a look at the Euro Swiss. So we'll come back to Trading View here, and we'll have a look at the Euro Swiss. Let's just delete our lines from last time. We already know what happened there. Okay, Euro Swiss. By the way, I'm just choosing the top one here, which is FXCM data, but you can again link it to quite a lot of brokers. If you use Oanda or other forex brokers, if they're in there, then you can use them. Okay, so we actually have. Oh, I'm looking at the wrong. Hold on, let me just check which time frame we're looking at there. 240-minute climate. So it says we have a near sensible long, but doesn't look like we actually have that on the chart. Let's have a look. Maybe if we use different data from a different try again. Try it from Orlando. Oh, okay. So it might be that the scanners are not quite syncing up here because we have a thin blue dot here on our 240-minute time frame, which according to our scanner should be a thick blue dot. So thick blue dot will tell us we have probabilities to the upside. A thin dot tells us that we don't have probabilities either way, whatever the color. So considering our auto climate app is telling us that we don't have probabilities either way, I'm going to move on to a different opportunity because it's just not worth our time placing trades where we don't have probabilities. So let's have a look at the next one down, which is the pound Aussie. That seems to be what we're looking at here. Again, 240-minute climate. So let's take a look. Pound Aussie. Also, to be fair, the euro and the Swiss had news coming out over the next couple of days, which could increase volatility. Whereas I think with pound Aussie, we've got a little bit more space. Okay, so let's have a quick look again. Just going to squidge out price so we can see what we need to see better, and it's nice and clear. Okay, so we have on our auto climate, we have a thick blue dot that tells us probability to the upside, which tells us we have a confirmed upwards climate. It means we're looking to go long. And that should be the question that we ask ourselves, again, regardless of what you trade or how you trade. Question number one should always be, should I buy, sell, or do nothing? We already looked at before a thin dot on our auto climate, and that was a very easy answer. Let's do nothing. In this case, we have a thick blue dot, probability to the upside, meaning I should buy or I should be looking to buy. There's other steps for us to get all of our probabilities together to actually make that worth doing. But overall, looking like we should be buying, we should be looking to buy. Now, another cool thing, for those of you that might follow us and know what these means, we have our statistics on our side as well. So these statistics tell us what normally happens in terms of how long that market usually moves to the upside, how long that market usually moves to the downside, and how many candles we're currently going in the direction that we're currently going in. So if we just take out that middle one for now, let's just ignore that. Usually this market would go up for 4.61 candles on this chart. Let's just round that up. You can't have percentages of candles, right? So 5 candles normally goes up for 5 candles. We're on candle number 1, which tells us that we have probabilities of a continuous move there to the upside based on what normally happens. So that's a good thing as well. So that's not a vital thing necessarily, but it's nice to go in our favor there. So far, 2 things with climate lining up in the way that we want them to. Now, just because we've answered question number 1 and decided that we're going to buy, does not mean we just buy at whatever the price is. That would be buying at a subjective price, because it would be buying at whatever the price is at the time that you happen to be sat there looking at it. So what we want to do is identify with question number 2. Let's put it down here. Question number 2 is, if I buy, where? Or if I sell, where? Where specifically? And by where, I mean exactly what price is. So this is where we bring in auto UFOs. So again, for those of you that are new to it, auto UFOs, UFO stands for unfilled order. So let's just put that in there. So unfilled order. Essentially what that means is there are buy orders in the markets and sell orders in the markets. That's what makes them go up or down. So if there are a bunch of buy orders, for example, at our green UFOs, we want to be buying there. We want to be buying when a whole bunch of unfilled orders are there. We want to be buying when there's a lot of buy orders, because the more buying there is, the more likely it is to beat the sellers and push price up. If we're selling, then we want to sell at these red UFOs where we have sell unfilled orders. If there's a whole bunch of selling going on, it's more likely to beat the buyers and push price down. So we want to be getting in at those areas where we have higher probability of it working out in our favor. Now, those aren't guarantees. There are, again, extra layers to this and risk management as well, just in case we're wrong. We have to accept we could be wrong. Of course we can. But overall, again, we're using technology to help answer these questions. We used Auto Climate to answer question number 1 and tell us we should be looking to buy. We're using Auto UFOs to answer question number 2 and tell us where exactly that should be. Now, there is a further layer to this, which I'll just explain, because you may be thinking, there are a few UFOs. We've got a few green UFOs. How do you know which one to pick? Do you just pick all of them? Do you just pick the closest one to current price? What do you do? Now, again, it's up to you how you do a methodology. You may say, I'm going to take all of them. I'm just going to place all of them and hopefully one of them will work. That's fine. You may say, I'm just going to take the closest one to current price, whatever one that is. As long as you do that consistently and that's how you do it, you'll be able to backtest that. You'll be able to collect data over time and see what works. For us, what we want to do is narrow this down even further by using, again, technology to help us out. So you may have noticed that on the left-hand side here, which is my bigger time frame, my 4-hour time frame, which is the time frame that we use for climate, so where we have the probabilities on a bigger time frame, I also have a 9-period EMA on this chart. Now, the EMA is important because EMA, by the way, stands for exponential moving average, and moving averages follow price. It's collecting, in this case, the last nine periods, nine candles, and giving us an average of those 9 candles. It's exponential because it puts more weight onto the latter candles than onto the prior ones. So EMAs are important because people use them. It's kind of a self-fulfilling prophecy, like with anything. Does Fibonacci retracement work by themselves? Are they magic? Maybe, or maybe it's because people use them a lot. And so they're placing their orders in the same places. Are EMAs magic? Are they beautiful things? Yeah, but maybe it's because people use them a lot. And so they're putting their orders in the same places. Ultimately, the thing that moves price is buy orders and sell orders. And so all of these different techniques, all of these different indicators just encourage buy and sell orders. Now, we use Auto UFOs to tell us that we have buy orders in this case. What we also want to understand is, based on using the EMA, this line here, based on a way of trading that is very, very common, where are we going to have more buy orders? Now, a very common application, a very common way of doing things in trading is that, see, we have the EMA is just there, that fine blue line there, and price is above it, price is currently here. Usually, the theory is if price comes down and hits the EMA, people buy it at that price. And when I say people, that can be retail traders all over the world that have EMAs very easily and cheaply downloadable on their platforms. That can also be fund managers as well. So we have buy orders coming in as a result of our UFO. The UFO has already gone through the price data and said to us, look, there's probably buy orders waiting here. So we have buy orders waiting there. And we would be lining it up with buy orders that would be coming in as a result of the EMA. So overall, we have lots of buy orders coming in. The more buy orders coming at the same price that we buy it, the better, because they're more likely to push price up. So that being said, let's have a look at these numbers. So the number for the EMA is 1.7996, which is just within this UFO. Perfect, those two things line up. We want that EMA to be enveloped by that UFO before we would consider taking a trade. And that's what's happened. We have our EMA enveloped by the UFO. So let's place a trade. Now, by the way, just to say, let's say it didn't line up. Let's say the EMA was here or here. Again, it's up to you to make that choice. You could decide to just take the UFO if you want. You could decide to just buy it at the EMA if you want. You could decide to add in breakouts or Fibonacci retracements, or it has to be a round number, or crossovers of different moving averages or different lines. Again, all of that is totally fine. What's important is that you are consistent in the way that you do things. So for us, we buy and sell at UFOs only. The EMA has to be inside that UFO for us to take that UFO, and that's just the rules that we have. But again, you can be more or less strict depending on how you do things. So I've just opened up the order panel here. And what I'm going to do first of all, before we place this trade, is I'm just going to draw some lines around it. So I have customized my fib retracements because I don't use them in the way they were intended. So I've customized them here. I'm just going to do that the other way around, so it should be more like that. There we go. Cool. So I've just drawn that randomly around those UFO lines. The UFO lines give us, on the right-hand side, the price range as to where we have those buy orders. So the buy orders that are sitting there waiting at the moment are between 1.79995 to 1.79805. That's the range of price where we have buy orders. So I want to use this top line. Again, we're using technology to make this easy for us, right? To give us the numbers. I'm going to use that top number, and I'm going to then add a couple of pips to give me a little bit of space. So what I'm firstly going to do is round it up, which will take me to 1.80000, like 1.8 on the dot. Just round it up to the closest pip, which in this case is a nice round number at 1.8 even. What I'm then going to do is add a couple of pips to compensate for the spread. So I'm just going to double click on that line, and I'm going to type in 1.8002. That's now my entry. So I use the number given to me by the UFO, which is the objective number where the price orders start, where the buy orders start, and I just added a couple of pips, rounded it up and added a couple of pips to give me a little bit of wiggle room. So now I'm going to do the same for the stop. So this stop should be below this bottom number, below where we have the last amount of buy orders that the UFO is picking up. So the number there is 1.79805. So I'm just going to round it down to 1.7980, and then I'm going to minus 5 pips to just give me wiggle room. So that's going to take me to 1.7975. I've just changed that on my drawing tool. So I've used the Fibonacci retracement lines there as a drawing tool. You might have noticed I've customized it to just have these two lines. I've taken away the normal lines that you would expect on Fibonacci because I use this as a drawing tool. So that black line at the top is my entry. This red line at the bottom is my stop. Great. Now what do I do if I'm right? What do I do if price goes in my favor? So the first thing we need to understand is how far can we take this? Do we have room for this to move to the upside and collect a lot of profit? In this case, we actually don't have that much. It may be that we just about rule this out, but let's have a look. So what we're going to do is we're going to come back over to this bigger time frame, which is this 4-hour time frame. By the way, our UFOs are on a 21-minute chart. And our climate, EMA, and final targets are worked out from our 4-hour chart. So let's just be logical about this, right? So we have confirmed upwards climate and probability that it continues based on the statistics. So on this time frame, on the 4-hour time frame, we have buying pressure. We have probabilities to the upside. What's the only thing that could get in the way of probabilities to the upside on this time frame? That would be a lot of selling on this time frame. So we want to get out before a whole bunch of sell orders come in that could change the climate. We don't want to be fighting against the climate. We don't want to be buying smaller time frame areas of price if we have a climate that is down. Then we've got a bigger force moving against us at the moment. The bigger force is telling us that we have probabilities to the upside. So it makes sense to use smaller time frames to be more accurate with that, to get in and out. But again, we want to make sure that we get out before probabilities that price changes. So we look to our closest sell UFO in this case. And the closest sell UFO is the one that I'm pointing to here. That's what we have. And the bottom number for that is 1.80353. I'm just going to round that down to 1.8035. So what I'm just going to do quickly here is just to see whether or not that is far enough away for us. So I'm just going to come over to the order panel, and I'm going to put in my entry and stop as I want them to be. And then I'm just going to put in what that target would be, which is 8035. Okay, so that is just about past the test, and I'll tell you why. Once you put in your stop loss and your profit target and your entry, TradingView is brilliant this way. It works out a lot of things for you. So what that has done is given me what the ratio is between them. So it's a 1.22 to 1 trade. As long as it's more than 1 to 1, it's still something that we would take. Again, that's something that you might have more rules on. You might want to have at least 3 to 1s available, or at least 5 to 1s, or at least 2 to 1s. For the purposes of just sticking to the methodology as objectively as possible, as long as we have more than 1 to 1 away, then it's a trade that we'll take. Obviously, we're not going to make that much money on it if we're right, but it might be an opportunity to just take a little bit out of the market there. So what I'm going to do is just draw on the chart, just a horizontal ray, where my target would be. It's 1.8035. Again, just to have visual reference on the chart. So whatever happens from now, whatever happens with price, if the UFO disappears or whatever, no problem. I can still see exactly where my entry, stop, and target was. So in this case, I'm just going to double check all of my numbers. My entry is 1.8002. My stop is 1.7975. And my profit target is 1.8035, which is based on our UFO over here. Now, what I want to do is tell it how much I want to risk. Overall, I'm going to assume that we're going to risk $100 overall on this trade. We're going to have 2 targets. The first one, we know where it is. We've got that there. So let's say if we're risking $100 overall, then we want $50 risk on this target and $50 risk on the other target. All we need to do is type in what we want to risk, and it will work out for us how many lots that needs to be. So $50, and then we're just going to click buy. So you've seen that order has now just gone in. And we're going to do the exact same thing for our second target here, or in this case, this will be our safety target. So I'm going to do the same thing again, click buy, 1.8002, go to my stop loss, that's already remembered what my stop loss is. My profit target, in this one, all I need to do is, again, use the tools, use the technology of TradingView to help me figure this out. So if I am risking 27 pips from entry to stop, and TradingView's worked that out for me, and I want a 1-to-1 target, which is what our safety target always is, 1-to-1 away, then I want my profit target to be 27 pips. You notice this number has now changed to 1, exactly 1. The reward to risk ratio is exactly 1-to-1, and that's what we want our safety targets to be. So once again, we're going to put in $50 here as our risk. So we're risking the exact same on each of our targets. 1-to-1 for our safety target, and just beyond 1-to-1 for our final target, meaning overall this trade will result at 1.11 to 1 if we're right. So again, not very much that we'd be taken out of the markets, but better than nothing, right? So when it comes to our safety target, again, TradingView has worked this out for us. All I did is tell it 27 because it's told me that my risk is 27. And then it's just told me exactly what the price needs to be, which is 1.8029. So I'm just going to put that on the chart. You'll notice that's only 7 pips away from our final target, 1.8029. Again, you can be stricter on this and say, do you know what, if my final target, which is the one that's based on the UFO, if my final target is way too far away, isn't far away enough, or if it's too close, then I don't want to trade it. I want to have room to take this and make an average of 2, 3, 4, 5, 10 to 1. Again, depending on you, your risk tolerance, how often you place trades, how much you stand to risk, how much you stand to make, what's worth it for you. All of those things are subjective. The objective methodology tells you exactly what to do if you do want to take that trade. Exactly what numbers, exactly how to figure out whether or not you actually do place it, where you place it, how you use your EMA, and all those things. So we've gone through the methodology start to finish. Now all we need to do is just click buy here, and you'll see those trades have gone in. So that's our trade that's in. Again, overall not a brilliant trade in terms of reward, but followed the methodology, and hopefully the example is helpful. Okay, so let's just expand on this a little bit again and explain, just seen somebody come into the room a little bit later, just explain again and recap why we placed this trade. We use our Auto Climate, which is a free app, by the way. If you get a free membership at Trade with UFOs, just go tradewithufos.com/Becky and get yourself a free membership there. Once you've got that, you can download the Auto Climate app for free. The Auto Climate app helps us figure out, do we buy, do we sell, do we do nothing? And it will tell us that based on different colored dots. In this case, we have a thick blue dot that tells us we have probabilities to the upside, which means look to buy. So that's what we did, we looked to buy. We then use our Auto UFOs, which are these little flying saucer things that we have here on the right-hand side, on our smaller time frame to help us figure out exactly where we would buy. So that, again, we're using objective technology to tell us where we have probabilities that price is likely to turn. So if we're looking for buy orders, we look for our green UFOs. So we use the green UFO to help us in our entry. We layered on top the EMA from the left-hand side, from the 4-hour chart, to add more probabilities to this, buy orders coming in with buy orders. Again, just to add more probabilities. Once we then figured out that this was exactly the UFO that we were going to take based on those things lining up, we used the prices given to us by the UFO, rounded up a couple of pips for our entry, rounded down a few pips for our stop, and then worked out our safety target based on a flat 1-to-1, and worked out our final target based on the closest sell UFO over here on the bigger time frame. So that's the methodology start to finish. Again, you can layer extra things in there. You can take some of those things out. If you have more variables that you add, you will have less trading opportunity, but in theory, more probable. So they're more likely to work out. If you take away variables, and let's say, for example, say, no, I won't use the UFOs, I'll use the EMA only, or vice versa, or I'm just going to buy at market or whatever, you will have way more trading opportunities, but less likely to work out, less probable. So again, it's up to you to balance that depending on whether or not you're patient or impatient, whether or not you're risk averse or you embrace risk or whatever. That's up to you to decide. But hopefully this methodology, objectively start to finish, makes sense. Okay, let's look at the time. It looks like we might have a little bit more time to just look at other opportunities that we may have. So we're going to come back to TradeStation and we're going to look for some decent opportunities here if we have them. So we've just put on the pound Aussie. This is where we had probabilities there. What we're going to do, we're going to come down to daily climates now, and let's look at the Euro Swiss there. Just as a random example, I want to use different timeframes to just give you sort of higher timeframes here. Before we were using 2 40-minute versus 21-minute. Now we're going to use a daily versus a 55, just to give you slightly longer term swing opportunities. So we have the Euro Swiss there, near sensible long on our daily climate, which has a blue box. So that's what we're going to look at. Euro Swiss on different timeframes. So let's draw this in. Euro Swiss. And this is 1 day. And same over here, Euro Swiss 55. Okay, we'll see if we have opportunities. We may not. We may do. We will have a quick look and find out. It looks like we do here, actually. Sometimes you might have joined these sessions and we've gone through and we don't find any opportunities because it doesn't quite line up the way we want it to. It's been lucky today. We've had 2 that have lined up. So let's have a look. So we have thick blue dot, probability to the upside, confirmed upwards climate. We have statistics on our side. They're a little bit faint. I'll read them to you. Normally, this market goes up for 5 candles, just rounding up that number. And we're on candle number 1. So again, usually the Euro Swiss franc would go up for 5 candles on a daily chart. So that's 5 days, and we're on day number 1. So we have probability of at least a continuous move to the upside. So that's great. So we're going to look to go long. That's answer question number 1. Question number 2 is where would we do that? And see here, we have UFOs. We have buy UFOs. We have a piece of technology that is scanning through market data and coming back and telling us, hey, here are buy orders. We want to buy with other buy orders. It gives us more probability of it working out for us. By the way, as I said before, the Auto Climate app is free. You just need a free membership to be able to download that. The Auto UFO app on the right-hand side, depending on which platform you use, comes at a cost. On TradingView, which is the one I'm using, it's $34 a month, or you have yearly discounts. So we're using UFOs here to help us figure out our entry. So notice the numbers here for the UFO is 1.10527 to 1.10355. That's the range of price that the app has picked up that we have buy orders. Now, remember, we have to lay in an extra thing here, which is our EMA. So the EMA currently is 1.10535, which is literally just outside of our UFO. Now, why did I say we had an opportunity if we don't quite have things lining up and we want them to line up and we want to be strict on them? It's because the beauty of the M within our EMA. The M stands for moving. It's an exponential moving average, which means this line moves with price, which means if price moves down by a few pips, likelihood is our EMA will move down by 1 pip. We only needed to move down by 1 pip in order to line up with this UFO. So again, it may not, but I would be extremely shocked if that didn't line up together at the same time. It may even do that whilst we're watching it today. So if price moves down, EMA moves down slightly, we now have an EMA within our UFO that lines up, we take this trade. So you can be, again, more conservative and say, oh, you know, I'm not sure that it definitely will line up. So maybe you put on an alert closer so that you can double check that it lines up. For me, based on experience and seeing that this happens all the time, I'm quite comfortable to assume that it will line up and use this UFO to place a trade. So I'm going to come back, get my Fibonacci retracement tools because I use them as a because I use them as a drawing tool. Again, you might use fibs for different reasons. That's totally fine. For me, I just use them for a drawing tool to help me know exactly where my entry and stop, etc. are. So we have the number to start. This is going to help us with our entry, 1.10527. So I'm going to round that up to 1.1053 and then add a couple of pips, and that's going to be my entry. So 1.1055, that's going to be my entry. So I'm just going to double click and type in the number there. So that black line is now my entry. My stop loss, I'm going to take this bottom number, which is 1.10355. I'm going to round it down to 1.1035, and then I'm going to minus 5 pips. Give me some wiggle room. That takes me to 1.1030 on the dot. Now, this is a very, very tight to another rule that we may have, but let me explain. So notice we have other UFOs below us. In fact, if I just squidge price a bit, we might find that easier to see. Okay, so we have many UFOs below us. Now we want to make sure that we get out of a trade not within a UFO. Because in this case, if we're buying to get in, which is what this entry will be, a buy order, then we're selling to get out. Our stop loss, if we're wrong, is a sell order. Now, if that stop loss happened to fall within another UFO and it literally misses it by a pip, but if it fell within a UFO, then we would be selling in the middle of a bunch of buy orders, which would mean that we didn't have a lot of probability that it would be working out in our favor. We would likely to sell out in the middle of a bunch of buy orders and then see those buy orders push price up, and we've lost because we got out too soon. So with that, we wanted to make sure that if our stop fell, I keep saying fooled for some reason, bad English. If our stop fell within a UFO, we would want to place it outside that UFO. So what would have happened, let's say this number, just for how those maths would have worked out, I rounded it down and took away 5. That took us to 1.1030. That's what I always do. That's the objective methodology that we use here. If that number happened to be 1.1029, then it would fall within the next UFO because the start price for the next UFO is 1.10292. So again, if we're going to be very, very tight here, very, very strict, then we would just leave that stop order where it is. What I might choose to do here, and this is a subjective interpretation of this, because literally I would be stopped out before, like by 0.8 pips before the next set of buy orders. So what I might choose to do is put my stop here below all of these buy orders. The negative with that is I've just increased my risk to reward. What I've also done though is increase the probability that this works for me. Because if I get out too soon, let's say there, if I get out too soon and price comes in, stop me out by a couple of pips, hits another stack of buy orders and goes off, then I've just lost the trade that actually I could have done well in. If we had a few pips difference between the original stop, so the original stop which was at 1.1030, and this one started at 1.1029, right? So literally a pips difference. If we had like 2, 3, 5, 10 pips then I would probably be okay to keep that stop as it is and use the other UFOs as a completely separate trade. Since the stop would fall within technically what the entry would be if we were to use the other UFO, I'm going to combine them. And again, that's me interpreting that based on my risk tolerance. You might put them all in as separate trades. Okay, so what we're going to do is we're going to take this bottom number, round it down. So the bottom number is 1.10002. So we're going to round it down to 1.1000 and then minus 5 pips, which takes us down to 1.0995. So again, I'm going to double click on that. 1.0995. That's now our trade, our entry to stop. Now again, what that's done is increased the distance between our entry and stop, which has increased our risk, which has decreased our profit potential, but increased probability by doing so. So that's our entry and our stop. So now we need our final target, which again, we're going to do what we did before and find our opposing UFO, our rival UFO, which in this case are sell orders. And we're going to take that top bottom number again in this case, which is 1.1173. I've just rounded that down, obviously, 1.1173. So let's put this in. And we'll put in our entry, 1.1055. We'll put in our stop, 1.0995. We'll take our profit at 1.1173. So this is a 1.97 to 1. And again, just to show my point about how doing what I've just done has decreased profit potential. If my stop loss was 1.1030, which was where it was before, which was here, then it would be a 4.72 to 1. So you might be thinking, why would you do that then? Why would you not have your stop there? Because by having my stop there, essentially amongst other buy orders, I increased the probability of losing a trade that I was right on. So I'd rather capture a smaller move, but actually capture it, than be more likely to lose in exchange for maybe a bigger reward. Again, that's subjective. You might have had a different thought process on that. Okay, so that is trade number 1 with our final target. Let's just put the drawing tool in there as well, just to make it all nice and visual so we know where everything is. There we go. So that's our entry, our stop, and our final target. Again, we're going to risk 50 bucks on each, 50 bucks on one, 50 bucks on the other. Click buy. Our safety target, let's put that in now. So again, 1.055 to 1.0995. Again, that's already remembered it. And our profit target is going to be the exact same amount of pips that we have in risk. So we have 60 pips of risk. So we have 60 pips of reward. That's how our safety targets work. And again, $50 for that. So 2 separate targets have gone in. One at this price here, which is going to be 1.1115. Okay. 2 targets have gone in, one at 1 to 1 away, to just capture a quick amount of profit. Helps us to limit the amount of times that we're wrong by at least breaking even. If we hit 1 to 1 and then it goes against us and hits our stop, no problem. At least we didn't lose anything. So we put our safety target in there at 1.1115, and we have our final target a little bit further away based on the UFO on the bigger time frame at 1.1173. Again, we kind of discussed here different rules on our stop losses. There are different interpretations of our stop loss that may change the dynamic of this trade. Having a stop loss here, which was objectively would have been 1.1030, and technically was 0.8 pips away before next set of buy orders. So you could very well argue that it's not within buy orders, it's just with outside of them. So great, that's where I put my stop. Then I would have had a smaller risk to reward. My safety target would have been roughly there, easier to hit. And my final target would have been in the same place, but the distance would have been greater as a reward to risk ratio. There's absolutely nothing wrong with doing it that way, and that's a very valid way, and reducing your risk to increase your reward potential, but you would decrease probabilities by doing so. For me, I chose to increase probabilities by acknowledging that we were 0.8 pips away from the next set of buy orders. which means it could very well, with a little bit of spread and a little bit of slippage, very well have stopped us out at this point, hit some of the buy orders there, and then gone off. And we would have missed out on that, having lost money. So I increased the probability, but in doing so, I also increased the reward and increase the risk and decrease the reward. So again, either interpretation is absolutely fine. I'm trying to be conservative here with you guys, so that we're as safe as possible. That's my my general motto when we do these kind of things. But again, either interpretation is fine. The most important thing is that you are consistent when you do those things, or your rules are, you know, they are subjective in terms of what makes more sense to you, but that they are consistent and therefore objective. So hopefully that makes sense. Okay, so we put 2 trades on today. We have the Euro Swiss long, and we also have the Pound Aussie long. We had Euro Swiss on slightly bigger timeframes, so swing trades that are likely to last a few days, depending on whether or not we have a lot of volatility or whether or not we're right or wrong, will depend on how long that takes, but normally a few days. And then we had the Pound Aussie on slightly smaller timeframes that are more likely to last maybe a day or two, or maybe even a few hours if we were to get in. So next time we do this, next time we do a Nailing FX session, we'll come back and look at what did happen. Did we hit our profit targets? Did we hit our stop losses? What do we learn from it? Would we have cancelled it based on any changing market conditions? And then we'll look for new opportunities as well next time. Any questions, you can email me, becky@tradewithufos.com. There's also tradewithufos.com/Becky. Once you have a free membership, you can ask me questions here in a public setting so that I can answer them publicly and other people can learn. Otherwise, if you really don't want to do that, that's fine. You can email me, becky@tradewithufos.com. Otherwise, guys, that's me done. So hopefully this recording was helpful. Hopefully you understand the methodology start to finish, why we do what we do, how we do what we do. If you have any questions that you can email. All right, guys, have a great rest of your trading week, and I'll see you next time. Take care.